Imagine a deal where the price moves above the market, protecting shareholder value, but demanding careful scrutiny. Robinsons Land is transferring 6 malls to RL Commercial REIT at a premium share price, creating a distinct advantage for existing investors. Here's how it works. The exchange. Robinsons Land swaps 10.62 billion pesos worth of commercial assets for 1.29 billion newly issued RCR shares, priced at 8.25 pesos each. This price stands roughly 17% higher than RCR's closing rate before the deal was approved. For shareholders, a premium price means fewer new shares are issued, limiting dilution and making it easier for the new assets to preserve or increase dividends. Had the shares been exchanged at market price, nearly 220 million more shares would have been needed. By opting for a premium, Robinsons Land accepts fewer shares, ultimately reinforcing shareholder value. Yet, this protection hinges on the income produced by the transferred properties. The question, will the 6 malls generate enough distributable income to keep dividends stable or rising? Here's the break-even test. With RCR's distributable income per share, the new malls must contribute at least 631 million pesos annually. That marks a 5.94% yield on appraised value, equating to about 3,937 pesos per square meter each year. For shareholders, this number is crucial. It's the threshold between accretive and dilutive outcomes. The assets are spread across provincial cities and secondary urban centers, each with different rental rates, occupancy, and margin profiles. Robinsons Land's system-wide averages suggest these properties can meet the hurdle, with 160,000 square meters, potentially supporting 1.3 billion pesos in revenue. But factors like utility costs and land lease charges temper expectations, especially since the REIT will lease the property land from Robinsons Land, a cost yet undisclosed and potentially decisive. Strategically, Robinsons Land strengthens its stake, recycles capital, and builds credibility for accretive asset infusions. For RCR, adding 14% more leasable space with only 6.6% equity expansion seems favorable, but real proof lies in post-deal dividend numbers. Premium pricing protects against dilution, but it's not assurance. Ultimately, the outcome depends on the cash flow from these 6 malls, how they perform, and whether they clear the 631 million peso hurdle. For investors, the deal is a carefully engineered bet. Will dividends grow or just tread water? The answer will be written in RCR's next dividend per share.